I got to admit, last week it was fun to take a little break from stocks and learn about NFTs and talk about crypto and some of the high growth names we've discussed in the past. And then also, full disclosure, I made that Zcash trade during the last podcast, bought Zcash at 150. Wow, that thing really took off, and rode that baby up for a couple days and just unloaded that transaction for 174. That was just a fun, quick trade, and just wanted to let the Gains listeners know what came of that transaction. So thanks again to Bill Ulivari on that one, and love bottom fishing for crypto. So now it's time to shift back to stocks, back to markets. You know, we talk about the Dow Theory a lot, and the Dow Theory right now, even though the Dow had a pretty decent week last week, popping off those lows, is still bearish. So we're going to bring on Chuck Carlson today, and we're going to talk stocks and check back in on the Dow Theory. I'm Andy Gersher, and this is Gains. Okay, so we're going to bring on Chuck Carlson, CEO of Horizon Investment Services and publisher of the Dow Theory Forecast newsletter in Hammond. He's also author of Winning with the Dow's Losers. Chuck, always great to have you on the Gains podcast. How you doing?
Good, I'm good, Andy. Thanks for having me back. Always a pleasure.
To get the conversation started today, we've talked about this for weeks now. The Dow Theory is bearish. Full disclosure, I got to tell you, I like that we've been talking about the Dow Theory, Chuck, because it did give us the heads up that there was some downside. Now, we've popped a little bit off of some recent lows, but the Dow Theory has been a good indicator so far. So I'll just let you kind of take it from there. Explain, just remind the Gains audience when it turned bearish and what has happened since then.
So just a real brief recap. The Dow Theory looks at the performance of the Dow Jones Industrial Average and Dow Jones Transportation Average, and from the movements of those two averages discerns whether the market's primary trend is bullish or bearish. Dow Theory has been around since the late 1890s. My firm has been using it since 1946, and while no market tool is infallible, it has a pretty good track record, and it pays to listen when there are some pretty definitive signals coming from it. And we had a fairly definitive signal on February 22nd of this year when both the Dow Jones Industrial Average and Dow Jones Transportation Averages cut through and closed below what we had determined to be significant low points. So we had lower lows in both the industrials and transports on a closing basis on February 22nd, thus triggering a bearish signal under the Dow Theory. Since then, you've had the market went a little bit lower. The transports went lower on February 23rd. The industrials went lower and bottomed out on March 8th. And since March 8th, you've had pretty aggressive rallies in both the Dow Industrials and Dow Transportation Average. I know a number of folks out there are probably wondering, was that it? Are we there yet? And there being a market bottom? My point, Andy, would be it's possible, but typically bear markets aren't measured in weeks. And again, we just went bearish February 22nd. They tend to be measured in months, if not years. Now, more recent bear markets have been shorter, but they still have been measured in months, not weeks. And really, we're still kind of measuring this thing in days since the February 23rd. Well, I guess it'll be or 22nd. I guess it's about a month.
Yeah, it's a month on the dot. Hey, one thing I really wanted to throw in there real quick is, the Dow Theory turned bearish on February 22nd. Russia invaded Ukraine February 24th. Another example of the charting and this stuff kind of telling you how things are, or things that are happening in advance.
Yeah, again, it tends to be forward-looking, and it doesn't necessarily predict everything, but I mean the markets are forward-looking, and the Dow Theory, because it uses those indices, will tend to be kind of forward-looking as well. Now, one of the things under the Dow Theory is, and you see this, just as there are significant declines during bull markets, you can have pretty significant rallies during bear markets. These are kind of bear market rallies. They tend to last anywhere from about 3 weeks to 3 months, and they can be pretty aggressive. And right now, that's kind of what the Dow Theory is saying that we're in is, we got the lows, the market went a bit lower, and now we got the inevitable kind of rally here, and it's been pretty aggressive, and it's been, it does what rallies do within bear markets, is kind of gives you pause and think, well, maybe this is the beginning of the next move up. Now, it could be, but I think in order for the Dow Theory to turn bullish, you will still need significant retests of the previous lows in the Dow Industrials and the Dow Transports. And that tends to take some time. So, again, I don't want to necessarily say that, this isn't the beginning of an onward and upward move in the market, and maybe the Dow Theory was wrong this time, and what we thought was a bear market signal turned out to be just turns out to be just kind of a correction within an ongoing bull market. But again, a couple of things. One, the signal was pretty definitive and pretty clear. Two, the backdrop, when you get back to those three major engines of market moves, which, you and I have talked about ad nauseum, but the reason we've talked about them ad nauseum is because it matters, and those are corporate profits, inflation, and interest rates. When you look at those three things, you kind of see a market situation that's probably neutral, tilting bearish. Inflation is certainly bearish. Interest rates are probably neutral, but potentially tilting bearish. And then finally, corporate profits, which have been really the big bullish pillar to this market, are probably still bullish, but I think probably starting to tilt toward neutral. So that kind of gives you this framework of a neutral tilting toward bearish market. Now, that doesn't necessarily mean a market that is going to crater, but it also isn't necessarily the backdrop for a market that's going to go on a sustained run. So, we might get a little bit more strength here, but I still believe we will get reasonable retests of those previous lows, the February 23rd low in the case of the Dow Transports, and that March 8th low in the case of the Dow Jones Industrial Average.
And the contrarian in me also is looking at this and saying, wow, we had a little bit of a pullback off those original highs. And, everywhere I read, oh, well, that's it. We're done. Okay. Let's, up higher from here. And that, often we talk about how I know it's cliche, the market climbs a wall of worry. I think it's a concerning thing to me when I'm reading out there that, oh, yeah, this is just the blip and we're ready to go. And as we said, this was a pullback and it's here and we're done and we're ready to move forward. And I find that very interesting. That makes me kind of, when I hear that, a little more bearish.
Yeah, I mean, it's certainly... I know people get antsy, and recent history is such that bear markets tend to be pretty short. And I mean,
look at the last one. We've talked about that. It was so short, and we've talked about compression. But my gosh, talk about compression. And it's just like me hitting you up on, to the Gaines listeners, they probably didn't know this, but I'm calling Chuck Monday morning. Hey, where are we at, Chuck? Is this it? Is this all in? He's like, well, let it breathe a little bit. But it kind of explain that.
And the last market decline, really that was March of 2020 at the beginning of COVID. And yes, it was short. But if you go back and look at that, it was short, but man, it was violent. I mean, in 27 trading days, Andy, the Dow Jones Industrial Average went down almost 11,000 points. So in 27 trading days. So yes, that was a short bear market, but it was definitely a bear market in terms of violent. How bad it bit you. And here, the markets. It really hasn't had that much of a bite. Yes, there are individual stocks that have come down pretty sharply. Yes, there are certain sectors that have come down sharply. But, if you look at the indexes, they really haven't done a whole lot to the downside, especially after the rally that we've had.
You
now,
could barely
again,
call it a correction, right? I mean, it really actually, especially after we've come back a little bit, when you look at the net, I mean, we really haven't sold off much. Go ahead. I'm sorry.
No, so somebody may look at that and go, well, that's the perfect argument why this isn't isn't a bear market, and ultimately that may turn out to be the case, but I think that you need to be patient here and need to kind of give this a chance, and the big reason, quite frankly, and the one factor that is in the mix here in this market situation that hasn't been in the mix for decades, quite frankly, is the inflation story. If you go back and look at previous, bear markets and corrections and things like that, inflation wasn't really an issue. It was, it was valuations. It was, recessions. That inflation that we have right now, that, we haven't seen inflation like that in 40 years. And maybe it is going to be short-lived, and maybe the supply chains are going to get all squared away by the end of the year. And maybe, Ukraine, Russia doesn't have a lasting impact on inflation. And maybe, maybe wage inflation isn't going to continue to run at 4 to 5%. But and maybe the Fed's going to be able to engineer a soft landing by raising rates and not crashing the economy.
Well, and especially since they've read economic conditions so well, as we've gotten here. And I'm being facetious,
where
obviously.
This was supposed to be transitory. So,
right.
Maybe all those things do turn out, and presumably, if that's the case, then maybe we have seen peak inflation, and that's not going to be an issue, and maybe it is going to be on or an upward. And I don't want to discredit. Maybe that's going to be the case, and quite frankly, that's also one of the reasons why we don't do we're not all or nothing players when it comes to the Dow Theory. But we'll take some money off the table, but we're still. We're not 0% invested in stock.
Unlike the gains listeners, where we've taken every dollar we have and all of a sudden shorted the market. No, I'm just kidding, right? No, that's a good point, and that's a great point that you make. Is you've never been an all or nothing shop.
No, and so, but I think that you still need to respect the setup here. You need to respect the Dow Theory signal. You need to kind of acknowledge that there are issues out there, and it doesn't hurt to maybe play it a little bit close to the vest. The biggest silver lining I see in the market right now, quite frankly, is the action of the Dow Jones Transportation Average, which, if you go back and look, the Dow Jones Transportation Average, which is one of the most, if not the most economically sensitive index there is, and oftentimes a leading indicator for the broad market, that bottomed on February 23rd. But when the industrials and the S&P 500 continued to move lower, it didn't, and it then has staged a pretty aggressive move. And when you look at where that is now relative to its all-time high, it might only be about 4 percentage points off its all-time high. So I can't ignore what's going on there.
And transports are often a major leading indicator. And explain that real quick, too.
Yeah, well, because of their, so many, transportation stocks are impacted by so many different economic variables, whether it's wages, whether it's fuel prices, whether it's, it's labor, whether it's consumer demand, institutional demand, international demand. They really cover a lot of spaces. And it is interesting that, you've got oil at, over $100 a barrel, and, transportation stocks by definition should be pretty sensitive to that. And yet you've had this very robust rally. Now, the rally that we've seen in the transports still is consistent with the types of rallies you can get during bear markets. So, in that regard, it is still consistent with that. But, if you and I are having a conversation, 4 to 6 weeks from now, and those transports have held their February 23rd lows and have continued to kind of push the envelope higher, that will kind of call into question the bear market signal under the Dow Theory. So, that is a silver lining. And hey, listen, I would be the first to acknowledge and almost welcome being wrong, the Dow Theory being wrong, right?
Right.
Who wants to be that guy that's like, well, I told you so. The market fell down 25%. But it's too soon to make that call. But again, if there is a silver lining here, I think it is the action of the Dow Jones Transportation Average, which has really come flying off that bottom. Looks pretty strong, doing it in the face again of $100 plus oil, and so that is an index that is worth watching. A lot of people. My guess is your Gains listeners, nobody else comes on this thing and talks about the Dow Jones Transportation Average because most people don't even pay attention to it.
Right.
You ought to. And right now, it is, to me, the most interesting index there is out there to give me some idea of where we might be headed. If in fact the transports have an about face after this rally and they go down and go below that February 23rd low, that is going to be a significant negative for the market. So how they perform here over the next 4 to 6 weeks is going to be pretty vital.
Well, and, even though we're getting a lot of mixed signals and nothing is 100%, but the Dow Theory has a pretty decent track record. And if you don't believe in something, you'll fall for anything. So using that Dow Theory and its track record, it is very helpful. And I agree with you 100%, especially with energy and all the different things going on right now. The Dow is super interesting. Now, we're going to go to a break here real quick. But before we do so, for the Gains listeners, grab your pen and paper real quick because we're going to talk plays on the other side of the break. Real quick, Chuck, why don't we go through the Dow Industrial high and low levels and the Dow Transport's high and low levels, and let's just get some levels to watch down on paper right now, and then we can talk about plays and all that other stuff on the other side of the break. So give us what you see as far as Dow Theory levels.
Yeah, and on the Dow Jones Transportation Average, the important level on the downside, and we're still kind of exploring the upward level here, but the level on the downside is the February 23rd low, which is 14,523.47. That's 14,523.47. On the industrials, the low that's worth considering is the March 8th low. That is 32,632.64. 32,632.64. Those are the lows that you would really like to see held here in order for the Dow Theory to turn bullish. You're going to need at least one of those lows to hold for the Dow Theory to eventually turn bullish. So
and
those are worth watching.
Okay, so those are real well-established bottoms. You mentioned on the upside, we're still kind of establishing that a little bit, right?
Yeah, correct. There is not an upside level that if the both of the indices went through, that you would say, it's a bull market. Now, you can make an argument if for example, the Dow Jones Industrial Average decided to go above its all-time high of what is that all-time high? The all-time high is 36,799. If it closed above that, and the Dow Transports simultaneously closed at their all-time high, which is a little over 17,000. I'll give that to you here. It's 17,039. If this rally just all of a sudden just blew past the previous all-time highs, you'd have to really question the Dow Theory's signal as a bear market at that point, because you'd have all-time highs and two averages, and that would be a little tough to sit there and say you're bearish when you see that. I don't think that's going to happen, but if I think what's happening right now is the market's trying to establish those rally highs, then what you'll see is a retest of the lows. If you have a successful retest that does not go through the lower lows, and then you have a rally that exceeds the rally highs being established here, that's the beginning of a bull market under the Dow Theory. So, that's so we're trying to establish what the rally high is going to be, and that next level the market will have to get above after it does its retest.
And one point to make here, too, that's very important is these levels we talked about aren't intraday, they are closes.
That's right. Dow Theory works on closes. Good point, Andy. So, yes, you need closes below those levels or above those levels to be meaningful under the Dow Theory.
All right, we're going to be right back with Chuck Carlson, continue the conversation, also talk about plays. I'll give Chuck his plugs on the other side of the break. Hey, real quick, be sure to subscribe, follow, and leave us a 5-star review on Apple Podcasts, if that's an option for you. And then, as always, subscribe and turn on those notifications so you know when new Gains episodes drop. We drop Gains episodes on Wednesday mornings and Friday mornings, so keep an eye out for them to be dropped then. Wednesday mornings and Friday mornings. We just kind of changed our schedule a little bit. Okay, we're going to be right back with Chuck Carlson. We're going to talk Dow Theory and how to play all of this. We'll be right back.
If you enjoy learning about communities, culture, and history, then Shades of the City podcast is for you. We will bring you stories like the legacy of Johnson Publishing Company, most notably known for Jet and Ebony magazines.
Basically what the world said African American people could not do, these magazines proved otherwise.
Subscribe now to Shades of the City on the Odyssey app, Apple Podcasts, or wherever you get your podcasts.
Back with Chuck Carlson, CEO of Horizon Investment Services and publisher of the Dow Theory Forecast newsletter in Hammond. Chuck is also author of the book Winning with the Dow's Losers. As always, plug time for you, Chuck. You have a great website that kind of is more attractive to the Gains listener, and I'll have you share that and anything else that you want to plug. Go ahead, Chuck. Sure.
We publish a newsletter on our publishing side of our business called Upside, and you can learn more about that at upsidestocks.com. It's a newsletter that focuses on small and mid-cap stocks, a lot of names that typically fly under the radar, and it does, I'm biased, but I think it does an excellent job of finding those sorts of stocks that, are today's small stocks but could be tomorrow's blue chips. So that's Upside. Upsidestocks.com is the website, and if you go to the website, upsidestocks.com, you can sign up for a free 30-day trial to the newsletter. So that's upsidestocks.com.
Are those more like Russell 2000 type stocks that are just smaller, that are sitting under the radar? A lot of those do very, very well. It's budding companies. Is that the kind of stocks that you're talking about?
Yes, yes. A lot of the stocks would be in the Russell 2000, and typically market caps anywhere from 200 to 300 million to up to 5 billion. So, primarily smaller companies in the Russell 2000. You might see some creep into the Russell 1000, but by and large, these are small companies that the names aren't household names in most cases, but we focus on quality in that space. So these are companies that are making money, typically companies with pretty attractive valuations and with pretty good growth prospects.
Could you give me one name that would sit on that list, just as a little teaser for our audience today? One name that sits on that list that you're like, this is kind of compelling. We might, maybe even a name we're not even familiar with. Sure. Sorry. There's
a couple. I like Matson, MATX. It's a shipping company that does a lot of shipping via the Pacific, Asia, so forth. They do a lot of shipping in the Hawaii area. That stock's done quite well, but it's a stock that, a transportation-related stock that I think still has plenty of upside. If you're looking for something in the technology space, Achelous Technologies, the symbol ACLS, is in the one of those semiconductor spaces, and it's a stock that we like and expect to do pretty well, and it has done pretty well. So that's Matson, MATX is the symbol, and Axcelis Technologies. I never pronounce it correctly. It's ACLS is a symbol, and just in full disclosure, our clients do own both of those stocks typically. All
right. Well, thanks for those two little picks that might not be on everybody's radar. Okay, so now we established those lows, and just a recap: the Dow Transports 14,523, and then the low for the Dow Industrials 32,632, basically. So we have those lows in. Now we have seen a recent pop. Actually, last week was pretty decent market, or a pretty decent week for the market, especially the Dow, across the board. But so where do we go from now, or where do we go from here? And what other, are there areas you're looking? Are you nippling? What's your play here, and what's your play for your customers as well, your clients?
Yeah, we've done a little bit more in the energy space. We try to take advantage of some periodic dips, and we've added to the energy exposure. I mean, now we've got some energy-related stocks in the portfolio include EOG, DVN, which is Devon Energy, MTDR, which is Matador Resources, which is one of those kind of small-cap stocks that I'm sure nobody's ever heard of. That's an interesting stock in that space. So we've beefed up that exposure a little bit. I think that there's an opportunity in some of the mega cap stocks that are still trading at pretty attractive values. One that we like quite a bit when you kind of go through the framework. What are types of stocks that I think are interesting stocks in this type of environment? Well, one, I don't think you want to overpay, so you want something with value. But two, you want something that's still growing. Three, you want operating momentum. And then four, it wouldn't hurt to throw a little dividend yield in there to provide additional downside support. And the stock that really fits that bill is Qualcomm, QCOM. It's in the semiconductor space. Stock trades for, I think, about 13 times its fiscal 22 earnings estimates. It has good operating momentum. It has pulled back from its high, maybe about 20%. And then finally, you get a dividend yield of about 1.8%. So, it really fits that profile of a growing company that you can buy at a good valuation and get paid a decent dividend yield. And that's a stock that I think is one that we especially like right now.
And we always talk about this, making hay in these type of markets, because this is where you get the deals. And when stocks move, as they always do eventually, or most of them, to the upside, that's where you make the that bottom fishing. I always say you make hay in the down markets. Now, is there concern that we are still bearish according to the Dow Theory, and there could be further downside? What do you put in place that kind of protects you from buying something and then it getting hit even more, and then buying something? You know how that game goes. I've been stuck.
It does. I mean, I think some people like to use stops. I don't, because I'm not smart enough to figure out where to put the stops, and it always seems every time I do that, wherever I put a stop, in other words, a price underneath the current price at which you're going to sell. I mean, sure, as I'm sitting here, Andy, it seems like every time I put that price there, the market just seems to, the magnetic pull to that pulls it down, I get closed out, and then the stock goes back up. So I don't really tend to. And
you get edged out by like a dime or a penny, or isn't that always how it happens? It happens. We talk. My boss and I talk about it all the time. We'll talk about our stops and stuff, and sure enough, we'll get kicked out of like positions that it's like literally 10 cents a dime. Go ahead. I'm sorry.
Yeah. And they always sound. That concept sounds great in theory, but I have never been one that has been really successfully implementing that. What we do to kind of answer your question is more at a macro level. Is say, listen, the Dow Theory is bearish. there are still stocks out there that we want to own, but we're going to take some cash off the table, and we're going to do that by probably selling some of our stocks on the bubble, some of our weaker sisters, maybe trim some significantly overweight positions and raise some cash. And maybe that means instead of being 100% invested, we're more like 85% invested. So, we're not making a huge bet on market timing, and that's kind of how we control things. And then if we go in and make a play on a stock like a Qualcomm, our defense, I guess, is that we're comfortable with the stock at its current price. We're really comfortable with valuation. So if it goes down, we're not, we're confident that's not a stock that's going to go down 50%. Unlike if you buy some of those stocks that were really hotsy-totsy stocks, but they didn't have any profits, and it was your guess where they would bottom out. And, you've seen some of those stocks go down 40, 50, 60, 70%. So we try to do that. And again, if you're buying something and you get a yield that's a premium to the market, that's one more thing that kind of might provide some downside support. And, we'll hopefully we buy it at a price that we can live with. And the fact of the matter is, most of the time when you're buying stocks during down markets, you're not going to pick the bottom. You might get lucky, but chances are you're probably not going to be, which means, you're probably going to buy a stock and it's probably going to go a little against you in the short term. And you're going to feel like a dummy, but hopefully, 6, 12 months from now, it's trading significantly above where you bought it. And that's kind of the mindset that investors need to have, because if you're sitting there with the mindset that you've got to spike a bottom buying these stocks, you're never going to buy, quite frankly, because there's always reasons not to. So, we try to protect ourselves by focusing on the value side of it. If you get a little bit of dividend yield to help you out, that's great. And, if the company, hopefully the company still has operating momentum. We don't typically buy really wounded companies that have really sold off. Now, we may miss opportunities, but we typically don't buy companies with really bad operating momentum.
And not necessarily a bad idea, because, we use cliches all the time, but they always say you don't want to catch a falling knife. And a lot of times that those stocks that get beat down and there isn't the fundamentals there in the backdrop, they can go a lot harder to the downside. They
can, because there's nothing really, there's no there to kind of stop them from going down. If they don't make any money and the fundamentals are weak. If, on the other hand, if you're buying something that might be off 20%, but it has pretty good operating momentum, pretty good clarity on earnings and revenue growing, and you can buy that at a reasonable valuation, then if you buy it and it goes down a couple of points against you, you can live with that, because, again, hopefully 6, 12 months down the road, that'll be a nice holding for you. And so, we don't really we're not trying to buy cheap stocks. What we're trying to do is find companies, again, with good operating momentum that have pulled back and are trading at valuations that we can live with going in. They don't have to be dirt cheap. They can be reasonable, and that's when we'll buy them.
And a big theme as of late has lots of people talking about that shift from the high growth names that did so well for 2 years to value. And that's kind of been this ongoing theme since the beginning of the year. Where do you see things? I just had a recent conversation where maybe growth has been overdone, and to the downside, that is, and there may be a return or a snapback. As far, putting the Dow Theory aside, because we know it's bearish, that theme, I know you hear about it all the time as well. Your thoughts, and where are we at in that cycle? Because sometimes value can take hold for years, not months. So I just would love to get your take on that growth versus value story.
I think if somebody was looking to tilt a portfolio, tilting it on toward value probably would be a better approach. Now, partly because growth has really outperformed value for much of the last decade, quite frankly. So, it got a little skewed there against value. Second, where I think this is an environment where value does matter more so, and so I would be tilting a portfolio. Now, remember I use that term tilting. I didn't use back up the truck and go into value. I still think. I'm kind of a barbell guy, in a sense that I think, at one end of the barbell, if you have growth stocks, and at the other end of the barbell, that you have value stocks, because there are going to be market environments when one type performs better than the other, and so why not own both? And if you're going to tilt to one end of the barbell right now, probably tilting a little bit toward value probably would be the play, but I would not ignore growth at this point, nor would I ignore value. And on the value side, again, we're not looking to buy kind of the cheapest deep value stocks. We're looking to buy, a stock like Qualcomm, which is a good growth stock, but I can buy that at 13 times their 2022 earnings estimates, and that's really a valuation, so to speak. So those are the types of value stocks that that we tend to kind of hope we can find, and those are the types of value plays that I think will continue to do okay in this market environment.
We've been talking obviously a lot of domestic, and that's the bulk of our focus, but there are emerging markets. It is another asset class. Full disclosure, when I when I'm buying into emerging markets, I always go with EEM. But there's a bunch. That's the iShares MSCI Emerging Markets ETF. Your thoughts on emerging markets? If you do dabble in them, what vehicle do you use? Are you familiar with EEM?
Yeah, the EEM is fine to go into that market. I know Vanguard has an emerging market fund as well. There are others out there. It's interesting, Andy. I mean, you can kind of put international investing in that value camp because, when you look at the valuations of international stocks, international exchanges, they tend to be valued cheaper than the U.S. So I kind of throw international in that value camp. Now, I will say...
Interesting. So you see that as a value play? So you think when you're talking international stocks, you look at that as more of a value play even than versus a growth.
Absolutely,
yeah.
Absolutely. Okay. And I think that they will. I think in market environments where value is working, that tends to help them work, and in situations where growth is really working. And I don't think it's a coincidence that when you go look over the last 10 years. And you look at how well growth stocks have done in the U.S. And how value typically has lagged, that lag lines up pretty clearly with what international has done versus U.S. over the last decade, too. I mean, if you didn't own any international stocks in the last 10 years, you didn't miss out on anything.
Right.
And that's why, I was thinking going into this year that, if this was going to be a better value environment, that would be helpful on the international side. And I think to a certain extent that may be. What has kind of thrown a bit of a monkey wrench, though, in the international side is the Ukraine-Russia situation and how that may impact emerging markets, and the other thing that's kind of thrown a monkey wrench into emerging market investments is this whole mess with China and the delisting of Chinese securities and how that's going to filter through emerging market funds and things like that. So there have been kind of exogenous events that'll hamper a little bit maybe the performance. But I think, if you're a value, if you're tilting toward value, then I would put the international on that value side of the ledger, and that would be one way to kind of tilt value.
Do you think energy, there's been a ton of talk and we saw it even much higher than it is now, but there are some really key things going on in the energy space well beyond even Russia and Ukraine. And that's an important thing to make, that you take Russia, Ukraine out of the picture here, good chance energy's a lot higher. than people have been used to for a variety of reasons, some dialing back of production and things going on here, and some other geopolitical things. But as oil has kind of come back a bit and it's starting to float a little higher, your thoughts, has that run been made?
No, I think there's still legs to that move. And one of the reasons is, again, if you go back and look at just how awful energy stocks were, for most of the 5 years prior to the last 12 months, they were awful. I mean, energy had become pretty much an afterthought in terms of its weighting in the S&P 500. I think it got down to 2%, between 2 and 3%, and that was a sector at one point. I know when I first started in this business, I think back in the 80s, you might have had 19% of the S&P would have been energy related stocks. So, the fact that they had just gotten beaten up so badly in 5 years that they had become an afterthought. Typically, when those areas start to rebound, the rebound has some legs to it. I'm not saying it's 5-year rebound, but I think there is still upside in that group. And the other thing that helps it is a number of the stocks in that group pay pretty nice dividend yields. So you have one more reason for investors to be buying those stocks to get some income. So they're going to be volatile. And we've seen that kind of volatility here because the price of oil bounces around. It's volatile. But I think, do I expect oil to stay above $100 a barrel indefinitely? No, I don't. But can the Exxons and Chevrons of the world do pretty nicely at $80 a barrel, $80 oil? You betcha. And so those kind of cash flows are going to translate to higher dividends and more stock buybacks. And I think those are going to be helpful for those stock prices.
Yeah, I mean, it speaks to one of my favorites in the space is Exxon Mobil, ticker XOM. I mean, on top of a lot of potential, and we've seen a run up in it as of late. The thing still throws like a 4.5% dividend, so you're also getting paid to hold these stocks too, which is nice. Right, and that and again, that is one more reason that investors probably will continue to flock. There was a time where there was some question when Exxon was yielding 7 to 8% whether that dividend was secured, but they're generating so much cash flow right now because of the high price of oil. That dividend is very comfortably covered. I mean, they're buying back stock again, and you're telling me? I mean, because the thing is, it's 4.5% now, but before 6 weeks ago or a little farther back, you're locking in a 7% dividend yield. And once you buy it, I'm like, for instance, my shares of Exxon, I'm locked in at a much higher yield than right now. And I was like, is this really safe? Because we've talked about it before. That is a warning sign when there's a really, really high dividend yield for a stock that can, indicate that there may be a loss in share price or there's some other issues. But with the nice thing about Exxon is you got that yield locked in and the share price has moved higher. And wow, I mean, it's just I look at that dividend and boy, that's a good example of why when you have really, really good companies that have decent dividends and they're beat down a little bit, buying those shares, because not only are you looking for more growth, you're getting a fat yield. I mean, that's almost like the best of both worlds. Yeah, you wait for those stocks to come back, so it's a little bit more palatable to if I got to sit with a stock a little bit and nurse kind of a recovery in that stock, if I can make 3-4% on my money while I'm waiting, especially in the low interest rate environment that we still exist in today, that's pretty good. So yeah, that's another reason why I think investor support will continue for a number of those stocks. All right, as we're wrapping up today's Gains podcast, what are your closing thoughts on both the Dow Theory and where we're at? And just give us your parting shots this afternoon. Yeah, I think investors just need to be a bit patient. I think a trait that we all share is impatience, and that fear of missing out, and these types of rallies
kind of generate that. But I think you need to let this play out a little bit more. That there are factors out there that could present significant headwinds for the market. And finally, watch the transports. The Dow Jones Transportation Average is usually the canary in the coal mine. So see if that can continue to behave and certainly hold above its February 23rd low. The longer it can do that, and the better the stock performs. That's a good harbinger for what the rest of the market. So watch the transports.
All right, a big thanks to Chuck Carlson, CEO of Horizon Investment Services and publisher of the Dow Theory Forecast newsletter in Hammond. Chuck is also author of Winning with the Dow's Losers. Give us that special website, Chuck, for the Gains listeners, stuff that we like to potentially buy.
Yep, that website is upsidestocks.com, and you can sign up for a free 30-day trial to our newsletter, Upside. That's upsidestocks.com.
All right, outstanding. And hey, be sure to subscribe, follow, and leave us a 5-star review on Apple Podcasts, if that's an option for you. And as always, subscribe and turn on those notifications so you know when a new episode drops. Our next Gains episode will drop Friday morning, and we will see you then.
A News Radio WBBM podcast powered by Odyssey.